Good morning, everybody. Welcome to the Flow Show. It's Tuesday, and welcome to some of the Yanks back from their day off yesterday. Hope you had a good one all. Morning, Kay.
Good morning, Ryan. Good morning, everybody.
How are you doing? All right?
Yeah, good, man. Good.
Good. Well, let's get right into it from the off then. Start, as we often do, over in the sunny land of China. Chinese Foreign Ministry said on the US warning China against a weapon supply to Russia, the US should stop fanning the flames of profiting from the situation, and certain countries must stop fueling the fire in the Ukraine conflict. As mentioned yesterday, there's been a big pickup in rhetoric between the US and China. Obviously, with the anniversary of the Ukraine war going on, Putin's been up in his I suppose it's called it State of the Union address in Russia. He was saying, among other things, that our next steps are to strengthen the army and navy and should take into account the experience of the special military operation. We expect cooperation to enhance with India, Iran and Pakistan, all largely enemies of the US. The rest of his comments are pretty much as you'd expect. You know, we started this because of other person's actions and we wanted peace and blah, 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 a whole load of waffle crap. So not surprising, some of the comments there. But he has, as mentioned there, pulled in some other countries into the sphere. And obviously China have meetings in Russia this week as well. Some high-level officials traveling to Russia for meetings there. So it's all centering around this geopolitical stuff going on at the moment. And aside from that, the Netherlands warned. Let me just stop me squawk.
Did we lose you, Ryan?
Yeah, I'm here, mate. So I just turned the squawk off. Just speaking about the Netherlands, they had to turn away a Russian attempt to sabotage its energy infrastructure. Apparently a ship was sailing around some energy stuff in Netherlands waters, and they had to send the Coast Guard out to see those ships off. So some stuff picking up there as well. It's not looking good on this. These headlines are coming more and more, aren't they, Kay?
Yeah, I mean, we can always say and hope, of course, not that things are not going to get worse. But when we look at the actions and what's going on, I'm quite I'm suspicious that things may get worse before they get better. And China's role is getting more and more mixed. They are really trying to straddle the whole risk board. I mean, and dragging stuff like South Africa, India, Pakistan, whatever into the frame is not really good. I mean, they're really trying to build that belt east-west, right? So
yeah, exactly.
Yeah, I don't like how things are developing now. Are we going to get worse from here? I don't know, but things are certainly not looking better. That is a certainty, right?
Yeah, exactly. I mean, one would hope that China, maybe starts to play things down a bit. They did come out and say that Taiwan is wrong to be compared to the next. Taiwan is wrong to be compared to the next Ukraine. So who knows, that situation, another one bubbling around. But at the moment, it could just be because it's the anniversary of the Ukraine war that we're getting all this stuff, and maybe it quietens down. But for the moment, just keep an eye on risk trades, because one errant headline and markets will go a bit potty. So that risk is rising at the moment.
Yeah, that's the thing, right? I mean, you can say that there's not going to be any Taiwanese war or whatever, but in the meantime, if we take it like in a sanguine way and only look at markets, we can't really say for sure that this is not going to weigh somewhere on on some part of markets, for instance.
Yeah.
Even without things totally escalating, I don't think they will. China is willing to go to war in any way, but just put one and one together. I mean, those comments, Putin, then Biden going to Ukraine, then the balloon story, then incursions lately again into those waters, and Russia also making problem with the Japanese islands and things. It's just one after the other, right? And we are hopefully at the worst of it, but yeah, in the meantime, we have to take it into account.
Yeah, and I've seen this time and time again, as I'm sure you have, Kay. Sometimes the weight of headlines can just get a few people hitting the sell button and running to safety, even if there's no real escalation in those headlines. Just the amount of them sometimes can get people thinking this is more trouble than perhaps it's worth. And we see, risk taking a hammering as traders move into some safe haven trades, even temporarily. So don't be surprised if we suddenly see some sharp moves, if this rhetoric continues, just purely on a safety run from some players in the market. Seen that plenty of times before. Right, let's move on to Japan. And a former BOJ executive director, Hayakawa, says that he expects Ueda to change the Bank of Japan's policy to some extent, and that the ideal policy under Ueda is low rates and strong guidance. Bit of insight, maybe not. It's been confirmed that the upper house will hold the confirmation hearing for Ueda and his mob on the 27th of February, pretty much as we knew. So 24th is the lower house, 27th is the upper house. So that will come early Asia, right? That will come early or late Sunday night.
What is it? The Ueda thing?
Yeah.
No, it's on the 24th, so it should be Friday.
No,
right?
The 27th one.
I haven't seen that one. Sorry.
Yeah, I just said it. It's confirmed. The upper house 27th, which is
okay. Yeah, but usually those people just put their stamp on stuff, right? Yeah. It's the big debate on Friday, which matters, I guess.
Yeah, exactly. We may not hear anything different than what we heard on Friday, but you never know. We always are aware of where our risk points are. Japanese tens have been nudging up above the top of the YCC, that 0.5% mark. So keep an eye on that, because the pressure remains on yields over there in Japan. That's going to be a big action when we get this stuff from Ueda on Friday. Obviously the CPI report as well. The RBA minutes came out, and maybe a touch to the hawkish side. A couple of the key comments I picked out of that was that members noted that the cash rate was lower than policy rates in many other comparable economies. So maybe thinking from the RBA that they have a little bit of catching up to do to get on a level pegging with some others. But the surprise perhaps was that the board considered two options for its policy decision, a 50 pip and a 25 pip increase. So there were two on the table for that meeting. They decided to go for the 25, as we all know, but the fact that was a consideration puts a bit more hawkish slant on the RBA for that one. Not that you'd know it, given the moves in the Aussie dollar this morning. SMB's vice chair Shagel said that the waiting, still willing to be active on FX markets, ready to sell FX if the Swissy depreciates and buy if it appreciates. So continuing with their trading account, both sides of the market there. Their next meeting is in March. So that's the first meeting for them, quarterly meetings they run over there. A hike is expected there. Riksbank's Floden says we still think the Swedish crown is very weak, continuing his calls there that of inflationary pressures. And again, another bank turning a bit more hawkish than they were previously. The Bundesbank were out with their monthly bulletin and saying that the economic outlook is somewhat brighter, but inflationary pressures persist. The short-term outlook for Germany is more favourable than seen a few months ago. They're watching for the second round impact of quick wage growth and saying that will keep Eurozone inflation above target for an extended period. They're calling an end to inflation, saying headline inflation has peaked in Germany, but the core to decline only tentatively in the coming months. ECB's Wren expects the ECB will probably reach a terminal rate in the course of summer, should not rush into beginning discussions on rate cuts. Gold is lifted their forecast for the ECB's terminal rate to 3.5%. They see an additional 25 pip hike in June. For those who were around yesterday, generally the market has priced a terminal rate at 3.75%. So goldies are still 25 pips below that. But as we forecast from banks, they can change like the weather. We've been talking about the Brexit stuff that's been going on the Northern Ireland Protocol, and it's doing its usual messy crap. 2 weeks ago, a deal was likely. Last week, a deal was likely to be announced. This week, Sunday, the deal is likely on pause. Today, the deal is likely not coming this week. So toss a coin when a deal is going to turn up. As I said, the market is numb to these headlines now, and when we get something, we'll get something, but don't hold your breath. That's all I've got on the headline front. Kay, have you got anything you want to throw in the mix?
No, not really on the headlines. No, on the data perhaps. I have something to say, but on the headlines, I think you've done pretty much the whole round. In the meantime, Putin is still speaking, so if you see any moves coming,
yeah, I'm keeping one eye on the.
Yeah, just keep an eye on those. But
yeah,
yada yada for the time being.
Yeah, well, we'll get stuck into the data because it's PMI day around the grounds, and largely all looking a bit better across the board. Well, we're getting a little bit of a split again between services and manufacturing. So you can see in Australia, both moving up, although manufacturing up just a pip. But coming across to some of the others, there we go. The divergence evident again in Japan. Services, manufacturing down, services higher. That's been reflected in some of the other numbers as well. If we come down to the others, where are we going? So in France, again, manufacturing further into contraction, but services higher. Germany, pretty much the same thing. Eurozone PAN number, same thing. In the UK, a bit better on both. Still in contraction in manufacturing, but an improvement and a decent jump in services for the new year. So at least for the UK, and we've seen a big jump in the pound on that because services is the bigger component of the UK economy, much more so than manufacturing. So the pound has reacted to that. Zoo as well, better on the data there. Both current conditions, less crappy than they were before, and the overall sentiment, a big improvement, beating expectations. Even the Eurozone economic sentiment improving there as well. So things are looking up. It's soft landings all round, isn't it, Kay?
That's exactly what I was going to mention. It's we need to be a bit careful with what we do in the general risk sphere. But it's certainly the start of the year is not as bad as a lot of people were expecting at the end of 2022. And so we may be in for some more need to reprice in everything, really. So I expect those hand-in-hand moves in bond markets to continue, because people have to reprice the sterling, have to reprice the euro as well, not only the dollar. And I expect this is not going to make our life much easier. It's going to create volatility, I think it's going to be ultimately positive risk, but we have to define what risk really means. If I look at the stock market futures, they are much weaker than the close of the week yesterday, or Friday or yesterday. But I'm not sure it's going to continue. If you look at risk in general, and that's why I'm saying it's not going to be an easy one. Euro Swiss, for instance, should be higher if risk is doing better, but it doesn't, because we have the SMB. Euro yen, dollar yen should be pushing higher, but then we have UEDA on Friday. The only one that really stands out to me, if you talk about risk now, because sterling has been a risk currency, especially of the last 3 years, and that is responding very well this morning. And I also think the cable has been, the move has been exaggerated a little bit, because we woke up this morning, we saw the US yields pulling up, and people were starting to buy dollars, right? And I guess the sterling market was running short, and had to scramble to go to the other side. But it's continuing. If you look at the sterling crosses, especially, they are continuing to perform very strongly. I'm not sure about the cable, but sterling crosses still look to be doing quite well, the sterling side. And then the other one where I'm a little in doubt, or again where things are not really as easy as they may look, is that this morning commodities, oils, were all like slipping and sliding, but they should hold up as well if risk is doing better, because the economic data are doing better. So I'll dive into some currencies later, but the risk, and I've been saying that before as well, it's going to be uneven, but I think some pairs are doing what they should be doing, and I'll show it a bit later.
Yeah, the oil one, if you're looking at the PMIs, you know, even though we've seen improvements, the manufacturing is still in contraction in a lot of countries.
Correct.
So, you know, that's not going to be such a tailwind for oil right now, and I think that's probably reflective in the fact that, you know, it's had what, a buck and a half, not even that, move today, or range today. We'll see what happens when we get the US stuff later on today. Maybe that'll tell a different story, and we're seeing if there's going to be these divergences, which we've seen before, haven't we, between the sectors, manufacturing and services. You know, different parts pulling in different directions.
And it has accelerated over the pandemic, right? These divergences. Yeah. So I mean, I'm not sure whether the market is really trading or looking at the actual divergence of everything, or just taking the sum of both and moving on, which seems to be the way this market trades right now. Yeah, and then about oil as well. I think this morning Russia said that their cuts were not to be implemented. Their production or output cuts were not to be implemented before March or so. So that may be another one that was weighing a little bit on the oils this morning.
Perhaps because they're shipping record amounts to China, apparently. So why cut production if you've got people waiting to buy it with open arms, even at discounts? Mike's asked a question of the euro. What do you make of the euro dollar not going anywhere fast, given the hawkish comments for 99% of ECB members? Well, they've been hawkish for probably the last 4 or 5 months now. So there's nothing really in the tank that to change the market's expectation for the ECB right now. Only if they turn more hawkish, maybe signal that rates are going up to at least 4%, or that 50s are going to continue further for a few more months after these ones, then maybe that would influence the euro. But the market knows where it's at with the ECB. Even a peak rate of 3.75 is going to put them below a lot of the global central banks. So it'll put them a bit behind on that front. But yeah, you know, the market gets bored of hearing the same old stuff 30 times a day. It can only price something for so long before it's happy where it's at, and then we move around based on what everything else is doing. So yeah, it doesn't matter what the ECB say, how hawkish they are along the same lines, the market knows where they're at. It needs something more to get the euro moving higher just on ECB expectations. Right, so looking around, I mean, yeah, Kay mentioned it. We got some dollar buying early this morning, and I personally think it was just a bit of a pickup from Friday. We saw a lot of profit taking from some of those moves, you know, that move up to 135 in dollar yen, yields going up to 390. Got a ton of profit taking. Then in the quiet day yesterday, you know, it held the levels, held the old resistance levels. This morning, we're seeing it move above as the market's coming back into it. But we couldn't get that close to 135 again, and yields have been the measure of it again today. Look at those 10s, they're holding up, you know, picking up from the Friday dip, but they're not really getting up to that 390 mark or putting in a decent test of it. And I think for me, that's going to be the marker for today. If we maybe test it but can't get above there again, we're probably going to see some of these highs and lows in dollar pairs holding because of that move in yields not getting back above that 3.9%. So maybe we get a closer move to 135, but if yields don't get above that, I would perhaps expect that to become a bit of a top short term or otherwise. Same for something like euro dollar, you know, not quite getting back down towards those lows in this move we're seeing at the moment. That's your marker going into today. Again, a lot of this is going to be driven by yields. Aussie dollar as well, you know, back into that zone. We had a little look above the 69 handle, couldn't hold it, back down we come. The 69 may be turning into the new 70, as I pointed out the last week or so. Needed to get a move back above that 70 handle and hold it. Didn't, got the failure, failed in the zone all the way down, but it's just becoming it's looking a bit pivotal, this zone again. If we get and hold below, then we move down. If we hold above, then there's a chance of moving up. But at the moment, we're just messing around, not deciding what to do. But the bottom end around that 70 area is holding for the moment. So a bit in the balance in this one. Euro sterling, obviously that move in the pound is giving that a jolt lower. I'm looking at the big figure to pick up a little bit, play a short-term long and add some maybe back into my long-term pot. The last long I had in this one was 87.70 to add, which I managed to run up before getting stopped out on the trailer 88.10. So I'm looking to play that game a bit if we get it to move down to 88, 87.90, that sort of area down there. Dollar China is again looking the same as the other pairs. Can we get back up towards these highs, put in a test of this 6.90, 91 area? That's my next big level. Got the 200-day moving average there as well. So a bit of resistance coming into there. Still long this one. 684 is holding for the moment, this break point here, this old fib level, and we're setting up a bit of a step up in support around 685, 85 and a half. So that's probably the first level that needs watching for this one, but a push higher is still on the cards for this one. My other trade that I've been in, the shorts off of the Hong Kong dollar off the band, I managed to get out a bit more of this in this move yesterday. Still not sure why that happened, but I don't care. Profit's profit, and I'll take it where it comes. Look to play the same game, reload if we get up to, you know, 84.95s, and then play the 84.50, 84 game again for knocking bits out on the way. Kay, you want to have a little look around?
Yeah, sure. And it's going to be, I'm trying to show you what and why euro is not really ramping higher on better data, because me too, I was thinking this morning, oh, those data out of Euroland are doing pretty good, and then the one that I'm first of all looking at is this one, the short-term differentials. And yes, they ticked up a little bit, but they have been very, very, very stable of late. And so if you then look at what's happening on in the dollar markets, we still have to know that the biggest market on the planet is the dollar treasury market, right? The dollar bond market. So you need to we're going to need to see moves breaking out of this little range, going back to smaller differentials, I think, to see the euro really tick up. This afternoon we are having the US PMI, so that could be interesting and get this one on the move again. And then if you look at the US 10s, as Ryan was already mentioning, we are not yet there, but the Monday move is gradually being undone. So if the US PMIs are a bit in line with what we are seeing in the rest of the planet and creeping up, we could have a retest of this 390 zone, which has been a bit of a level even before, as we can see here. So we should keep an eye on that up to 395-ish. And then psychologically, the 4%, of course, this technically I don't see too much of a level there, but the market will look at it psychologically, what to do, and likely drive the dollar yen into Friday, and then on Friday a whole new world can open on what may happen to the yen. Personally, I think Ueda is going to try and walk a fine line. He's not going to announce any huge changes or any huge moves. He's an economist. He's likely, and we can't forget that in the early 2000s, he was one of the, if it's not architects, really, one of the consultants for the zero interest rate policy. So I'm not sure what the market can really expect from him, but I can imagine that ahead of the event, we are going to see a bit of perhaps a bit of yen strength. That's possible. I'm just looking at what people are putting there. Okay, in the meantime, we're seeing the dollar pick up a little bit again. Okay, let's go on to cable. As we said this morning, the market was buying dollars. Let me put it on a shorter term one. So the market this morning was buying the dollar, and I think they completely got taken by surprise in the cable, at least. But we have to acknowledge that this 119, call it 70-80, is still going to be a relatively important level in the short term. And now we are already nearly back to where the traditional gateway lies, to higher or lower around the 121.40. Well, we're a while away. We are trying to stabilize around this 120. 70 figure zone, but I'd keep an eye on this 121.40-45 zone if ever we reach there on US PMIs, if they come in a bit weaker. And on the other hand, 119.70-80 is going to be a level to keep a close eye on. Euro sterling came and is now breaking below this little trend line, trying to break below this 88.10 again. We had a prior low, spike low set in just below 88. The figure has been already levels of interest in the past, so keep an eye on that one. If it goes down, and I think the market got taken a little by surprise there, so there may be some more to be done here in those sterling pairs. We may have a move down to 87.60. I'm still a bit hedged against my 88.5. Yeah, 88.5 call. So to me, it can go up and down. I don't really care as long as it moves, and it moves fast and far. But yeah, I wouldn't exclude a move down to 87, perhaps 87.60s. I don't know if there's strength enough in the sterling to really go down to the low 87s or put my big zone in danger. I'm it's still more than 1% away. So I'm not sure we can get there. I'll be hedged if it comes. I'll be completely unhedged. I mean, if it comes down here. Dollar yen. Yeah. So as I was saying, the dollar yen is trying to make up its mind in the 134s right here and now. If ever we get better dollar numbers and put this US 10-year yield back above 390, we cannot exclude a break through those prior highs and get a move into those 100 and 200-day moving average zone. And if you look at the cloud today and into the 24th, when Ueda is going to speak, we are going to hang around those 200 DMAs and the 100 DMA and the top end of the cloud. So if ever, and that is still an if ever there's another 100, 200 points to do on the top side in dollar yen, I would really pay very, very close attention to what's going on here. And then from next week, this cloud is starting to come off. So that's going to either make a break easier and go push higher, or the Japanese are going to watch this and trade accordingly, and we may have this spike and then come back to lower levels. So all of that remains to be decided. In the meantime, if we'd be logic on risk and data and on yields, the logic would be that we are going to have a try back up, but again, between the logic and what's to happen is sometimes a different thing. Okay, on the oh yeah, one thing on the euro. I know that people are watching this 106.60 very closely. We are trying to break lower. I'd say there's another bit of a level here around 106.30, 35. To me, it's going to be here whether we hold or not the 106, 105.80, 106 zone is to me relatively important, because if it breaks, there's not going to be a lot holding us from doing another big figure lower. And this is widely expected as being a very big support here in the 104.60.80. If ever we get down there, there's going to be the big support. Top side now, already 107 the figure. We're having a bit of fib activity there, 107 the figure, and if we break back above, then this whole 107.5, 108 zone is going to be monitored, as that looks to be like the make or break zone on the top side right now. I'm not going to narrow this one down, because every 10-15 pips there's stuff in there, but I think it's going to be 108, 107.5, 108 for me going into the rest of the week. What else? Yeah, dollar China you've covered, but then we have to keep an eye on what's happening in the emerging market sphere. Now, the US yields are higher, and this dollar mix is trying to recover a bit towards the 1850-52 zone. But if we think that risk is or should do better on the back of better data, paradoxically, this mix could actually do a bit better. So dollar mix is going to be important here, and on the prior low around the 1830s. But for the time being, the break is still on. So those EM currencies and especially the mix still, I would argue, is looking pretty good to me. So we have to look at what's happening around 1960 now. If we get a bit of a recovery, I thought we could have a bit of a recovery in the past few days, at least up to 19.75. Why not even up to high 19s? But it's still doing very well. And unfortunately, I'm starting to read a lot of stuff about carry trades right now, and that is really starting to annoy me, because I'd like not to be too many people in such trades. If it starts to be crowded, then usually what happens is that people dive in, FOMO, bang, you drive it lower, and then we're in for a big rebound on the first set of data, which are less positive for risk. But anyway, for the time being, still oriented towards the downside. There's one that I'm keeping an eye on here, and that's this Euro Noki. As you've seen, since we broken above since we broke it above earlier this month, we've retested it and bounced again. I'm keeping a very close eye, on the oils. Looking pretty stable, actually rebounding as we're talking about. But I'm going to keep an eye on this, call it 89.90 zone on the Euro Noki, because if oils continue to be on the defensive, I might try to catch a knife here and see if we can get back above. And risk doesn't have to be big. If it goes below 1087, I'm going to be out. So that's in Euro Noki terms pretty how shall I say, conservative. This one is a different one, but again, if oils continue to, I thought we had this and we had this test of the low 10s the other day and then rebounded, but we are capping the trend line here. So keep an eye on what's happening around 1036.37 again on the dollar Norway. After the US PMIs, it could be, and we are not that far away. 0.5% in such currencies is not that far. So keep an eye on what's happening here at 1035.36. I could imagine that if we get better data, this goes for another ride higher. What else? Is there anything that the people want to talk about?
Do you want to look a bit more at dollar CAD, seeing as we got the CPI?
Oh yeah. And I showed that this morning as well. Good one. So the dollar CAD, we are in this wedge or whatever channel you want to call it, and we've retested it on Friday around this 135.25 and rejected. So this is going to be the level here to go into this afternoon's Canadian PMI. 135, 2025, keep an eye on that one. And on the downside, I'd say 134, low 134s, call it 134.0510. That is going to be the first port of call or the first support, in my opinion. And then below there, it's another 50 points lower to another 50 to 75 points lower. And then if really the CPIs come out strong and you get a weaker US picture on the other side of the medal, people are arguing that dollar CAD may be on its way back to 132. So be careful if this starts really to slipping hard. There is a bit of mileage there after the rejection here. So if we start to break below 134, the figure, just be a bit careful because it could accelerate. Another one that I'm keeping always an eye on is this Euro Canada. We're in this triangle. We're breaking out of it now, and that has to do with risk as well, because traditionally, and that's where it makes the picture a little bit tough to trade as well. Even with better European data, the risk picture, usually when it's risk on, Euro crosses tend to suffer, apart from stuff against the yen or Swiss also, but Euro commodities, Euro energy, whatever, tends to suffer a little bit. So we're trying to break the triangle, but ahead of the CPI, I'm really not interested in doing much here. To me, the level is going to be 143.25, a bit too close for comfort, perhaps going into the CPI and then see what happens. But the biggest one on the downside is again going to be this prior low where we stopped again. That's around 142.35. Keep a very close eye on if that would start to come close after the Canadian CPI. On the top side, I think it's 144.40.50 again. If you look at the moves that we had, we had this triple top formation. We went to the target zone of it, and now we try to get back up above 144, but failed. So keep an eye on what's happening at 144.40.50 if it goes up there. I'd say if the CPI don't disappoint too much, this one is for me a candidate to try and catch a top there and see if it can hold and where we end up on a close this afternoon. That for the CAD crosses. Yeah, CAD yen. I've been looking at this CAD yen, but it's big because. But is it more because of the yen or the CAD? I'm a bit torn in between knowing what to do with it. But okay, it's hovering around this trend line. To me, for the CAD to really start going, we have to break above 101.5 again. If in turn we break back sub 98.5, I know it's a bit of a wide range, but I don't really see much else in there right here and now. So if it goes back below 98, 40, 50, then it's bad news for this pair. So that about the CAD yen. And I think that's it for me for now.
Thank you, mate. I'll just take it off you quickly. Ali was asking a bit more about euro sterling. Let's get that up.
Well, I've showed the euro sterling, right? I mean, the levels are relatively clear.
Yeah, I was just going to. He's asking about my positioning in it, so just going to explain my overall view, my longer term view of that one, because I'm still long this one from 86.20s. For now, it's, as I mentioned, it's just about playing the range, just trying to play these little ranges and cable up, you know, the 87s, big level down there. Let's get into that. So, and then down 87.20 has been a big prior level. Then we got this zone down here. For me, I'm just Kay's trading around his option and whatnot. I'm still on the long side. I'm still looking for a move up towards 90s, even a break of 90s, which is potentially coming. Let's just zoom that in a bit. Where are we? Because if we do clear that, then we're going to be heading up towards 91s, 92s, maybe even 93s. But the cruncher here is, you know, down at 87s in the first instance, then this zone, and then if we're getting down to 86s, I can't really see us getting the move all the way back down here unless something's going really bonza for the UK or something's really bad for the Eurozone. You're looking to get long, I believe, as well. So look at your levels. I was long, as I mentioned earlier, around 87.70 when we got a test down there previously, purely because, you know, we've had this move down around here and it was a former support area. We get under, maybe we get a move down, but by and large we're holding above here. So that's sort of a secondary area if you want to look for longs in this sort of zone around here. But a line in the sand would potentially be 87.20s, 87s, to invalidate this move that we've seen, this move up that we've seen from the 86s in the first instance. So if you want to be getting long down here, yep, you can do so. You can do it two ways: build up a position, maybe all the way down to 87, or do it in little pieces. You know, trade against these areas here, tight stops. If they don't work, fine. You try the next one. Doesn't work, fine. And then you just wait and pick up your pieces. It all depends how you want to skin a cat, Ali. You also mentioned about short euro dollar at 65, so you're doing nice-ish on that at the moment. Nearly got to your 106.40, so you know, hope you get there. You're short also Kiwi. Kiwi again is going to be an interesting one because there is a little bit of a risk that they do something less than the market expects with rates because of the cyclone and storm that they've had there. And I'm personally thinking about dropping a couple of little bids in, perhaps down here in case there's a little bit of an algo move down towards the 60 handle, because this one can move quite a bit if there's a bit of a surprise. The Kiwi, it's not unheard of to see this move 200 pips when the market's been caught the wrong way. So I don't think that anything that's taken as dovish by the algos, say they don't hike by 50 as expected, they maybe stay unchanged or go 25. I think that doesn't mean they've suddenly turned dovish overall. They're just taking into account the situation currently. I think it's a low risk, but a risk is a risk. So I might layer in some bids down there. If you're short and you get a move your way, you may want to think about taking some profit. You know, if you do see a spike down 100 pips, 150 pips, don't look that gift horse in the mouth. Maybe take some off, and if it bounces back, you can always reload it again. So take some profit if you see it.
Yeah, 62 is a big level on the Kiwi. I forgot to show it actually, because I have it. I have some interesting Kiwi as well. Been trading it from the short end, because I think there may be a surprise from the RBNZ not being as hawkish as or doing a dovish 50 or a neutral 25 it is possible in my opinion. So yeah, this 62 is a pretty important level, and then below there 61.60 prior low. If we get down there, I think your 100 points may just be there, you know, anywhere up anywhere between 60 and a quarter and 60 65 somewhere in that 30-40 point zone. That is possible. The RBNZ disappoints, but yeah, first of all we have to see what they really do.
Yeah, that 62 isn't going to stand up for much, being 30 pips away, 35 pips away when the if we're there when the decision comes out. So one thing I do with big levels like this, you can see it's a big support point. If we move to the upside, it's going to solidify that support if we come back down. If we break it over something to do with the RBNZ, what you're going to want to see is if it becomes resistance. If it doesn't, that's just a fake out move, and we probably mess around doing the same thing. But one thing I will say, you know, we talk about the fundamentals a lot on this show, and we talk about central bank expectations, and looking at things from a wider standpoint, it seems like a lot of central banks are, although they're moving towards pausing and lowering the size of hikes, they're in a position where they may be wrong. If you look at the Scandis, you look at the Riksbank turning more hawkish, look at the RBA minutes where they've said they've had a 50 on the table. The RBNZ, who some months ago apparently were potentially 2 hikes away from pausing, and now we're 3-4 hikes on from that. The Fed may be turning more hawkish. That's where we're at the moment. Central banks have hiked. They want to get to a place where they can pause and then get their rates back to a neutral level, maybe 2.5%, 3%. But they're becoming increasingly concerned that they may have to do more. That doesn't mean Kiwi's going to rally all the way back up to 65s, or the Aussie's going to rally all the way back up to 71s on central banks turning more hawkish. But you've got to understand the fundamentals. If they're going to get more hawkish, potentially the Fed are going to get more hawkish, and it's going to be the US dollar that's going to drive the moves. But overall, again, this is where the crosses are going to come into it this year. If the RBNZ have a little, a little bit of a dovish message coming in from their meeting, you're going to see a big move in Aussie dollar Kiwi, because the RBA all of a sudden had that 50 on the table. And the crosses are where you're going to see a lot of these moves coming in. So if you want to trade between the central banks, you may not get the mileage trading it against the US dollar and the Fed, but you may get better mileage trading them against some of the crosses, Kiwi versus the euro. If the Kiwi's going high on rates, the ECB is going to stop at 3.75. There's a divergence to trade there. Same with the Bank of England. So look around your crosses. I get the feeling that central banks are getting a bit more nervous about maybe having to move higher on rates. The data will tell us whether that's going to be right or wrong. So that's giving you a bit of insight, and obviously thanks to K-Man for all his stuff as well. Hopefully it all gives you a good bit of insight. Just quickly, a little bit of a pump. If you want to go and do this, I do a weekly show with Michael Brown at Pepperstone, the trade-off, similar to what Blake does. If you want to have a look at that, I've popped the tweet in there. You can get the link for that one and watch my ugly mug talking on TV. So have a look at that if you'd be so kind, and don't forget to follow us on the socials and give us a pump for the Flow Show. If you like what we're doing here, have a little retweet when you see the tweet goes out in the morning. That would be appreciated. Let's get more people in here so we can get our message across. Who's put there? Bran. Yeah, I watched that ugly mug. That's no way to speak about Michael, Bran. That's terrible. I'm going to tell him you said that. Anyway, thank you very much, everybody. Cheers, Kay. We'll see you all bright and breezy tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.